Good morning and welcome to the macro snapshot for today. We are Friday, July the 25th, 2025, recording this in the morning, as always. Okay, so let's just have a quick look, see what's going on. Some of the main news yesterday, there was a bit of sort of hawkishness in terms of the front end of the bond market. We had the ECB, so the European Central Bank, interest rate decision yesterday morning. As expected, they didn't do anything in the sense they didn't cut. But what the market took away from that was that Lagarde, before going on her summer holidays, really sort of gave the impression that the ECB was in a happy space, that the economy was doing relatively well, it was relatively robust. There's still uncertainty about the tariffs and any potential trade deal with the US, but overall they were relatively happy. They didn't see growth as being particularly sort of collapsing or anything. And secondly, they did see that inflation was more or less at target and under control. So all that to say that she didn't really expect to be cutting anytime soon. The market, as you can see here, this is the European pricing. You can see the market now by the December meeting is pricing in about a 62% chance of cuts. Hold on, this is a bit strange. 15 basis points of cuts. So not even a full cut by the end of the year. It is pricing in one more cut over the sort of the next year or so. But essentially, as someone said from the Governing Council, the bar is high for more cuts. So that was interpreted as being a little bit hawkish. And you can see the pricing here. This is for the December pricing, so in the overnight index swaps here. And you can see that just before the meeting, this is an intraday tick, so very short-term intraday chart. You can see just before Lagarde spoke at the press conference here, we were around about 23 basis points of cut, so almost one full cut by December. But what you can see is that the market immediately hawkishly repriced upwards, and even in the overnight action has gone up a little bit as well. So now we're at about 14 basis points, or let's call it like 12 and a half here. So basically only now half a cut priced in by the end of the year. So definitely a little bit hawkish. And we can see that with some of the market reaction. We can see that the front end of the German curve. So if we look here at the Schatz, which is the 2-year, of course, on the futures, you can see here on the price chart on the daily, you can see that there was a big fall, and even this morning still going down a little bit. So basically, yields going up at the front of the curve, but that also was all across the curve. So there's the 5-year, the bobble, and then if you go to the Bund itself, the 10-year, you can see that's also down, and for good measure, the Buchsel as well. So basically, at this point, sort of yields going up on the German curve, a sense that the ECB at this point is going to sort of do nothing for a month or 2 or 3, see what happens with Trump and the economy. But basically, any further hope of sort of extended cuts out. But that weakness in the German bonds, especially at the front of the curve, that was also reflected yesterday all across Europe. And we see here that the French bonds also took a bit of a dive, and you can see that also the Italian bonds, which basically on a comparative basis, you see this. Let's just have a quick look at the Bund. As you see, that sort of downward curving. You look at the French bonds, so downward curving, but then you look at the BTPs, the Italian bonds. So they did take a tumble yesterday. They're still definitely outperforming their German and French cousins. And that's just because the market is lacking the extra pickup. It gets a little more yield for these Italian bonds, about 1% more than the German bonds. And as we see here, it's about, at the moment, as we speak, about 90 basis points. So the market's still lacking that extra pickup in yield. And the idea is that the market is relatively sort of sanguine about the internal politics of Italy and also the fiscal responsibility. We have to say that Meloni's government has shown quite a lot of fiscal prudence over the last year or two, and the market is rewarding her and her government and Italy by a lower sort of borrowing cost. And you can see here that the spread over Germany is pretty low, only about 90 basis points. Not exactly the same situation in France. You see here in France, the spread has gone down a bit, but still it's not nearly. There's still a lot more nervousness about the French fiscal situation. Okay, so all of that was happening in Europe yesterday. And we can see that basically in the US, we also had a bit of a repricing in the US bonds. So if we look here at the 2 years, so this is the ZT, which is the future. So obviously the price, not the yield here. And we can see that over the last couple of days, that's also gone down a little bit. If we look at, let's say, ZN, so just the 10-year gone, that's gone down. And if we go out to the 30-year, not quite as much. But if you go back to the front end of the curve here, you can see a couple of things have happened. And we'll just put it back. I just want to show you this, the repricing here. So we'll go on to, so let's just look at the December repricing here, or the December pricing. So we'll go on an intraday chart of pricing for December. Let's let that load up. And you can see here that that's also similar to Europe, that is sort of hawkishly repriced. Let's just drag it back a few days. Remember, each one of these periods is 1 day. So if we drag that back a few days, going back to the 22nd of July, so basically the beginning of the week, you can see there that we're about at about 47 basis points of cuts priced in by December. So that's basically 2 cuts. And what we can see is that over the course of the last 3 or 4 days, as we speak, it's now up to about 42 basis points. So it's priced out 5 basis points. Now, why is that? A couple of reasons. Yesterday, we had pretty good data from the US. And although, there's a lot of doomsayers out there, people saying that the US economy, has to collapse because of tariffs. The reality is that yesterday we had the initial jobless claims. I think it was down at about 220,000, which is a very good labor market. That's not going high. So that's a positive. We had continuing claims, which is, creeping up, but still historically quite strong. You have to admit that. And also we had new home sales yesterday, which was a little weak. Now, you could argue, oh, it's a little weak, therefore it's weakening because of the high mortgages, and that's definitely a factor, but it was a lot less weak than expected, so kind of sort of stable. So the point is here that it looks like the employment situation is relatively stable. We've had relatively good retail sales. And so the US economy, people are looking at it saying, hey, the Trump tariffs, there is slowly in Trump's muddled way, we are getting a little bit more clarity. But it looks as though, as the weeks turn into months, that we will settle somewhere, around about 8 or 9 or 10 or 12%, 15% on certain industries, certain countries by the time everything's done. But there's a general sense, I think, that if the tariffs bite too hard and that the economy or the stock market goes down too much, Trump will come in and offer some deals. So there's almost like a sort of a put, the Trump put here that, hey, if things get too bad, don't worry, Trump will ride in. So just talking about the data, we'll get a little bit of extra information on the US economy today. We get durable goods. This is slightly old because it's June data. So here we are at the end of July. But nonetheless, this is pretty important. As always, look at the capital goods, non-defense. We want to take out, those very big ticket items like, I don't know, aircraft and, I don't know, submarines. So looking at the core numbers here, probably the capital goods shipped, non-defense ex-air, that's an important one. But all of those, we'll have a look at those and just see how the durable goods orders is holding up. And if that's holding up, again, that's going to give more sort of impetus to this idea that the Fed doesn't need to cut in any short-term reason. Inflation is still relatively sticky and the economy seems to still be okay. Although it may be slowly weakening, it's still quite robust. Now, just talking about the Fed, of course, we had that really to be honest, embarrassing meeting yesterday or visit by Trump to the new Fed building, or the Fed building, which basically is next to the water table, so it's costing $2.5 or $3 billion to reconstruct and renovate. Anyway, the point is that Trump is using this as political theater to put more pressure on Powell, to sort of give the impression publicly that he is incompetent, an incompetent manager. Poor old Powell was, I think, visibly squirming and uncomfortable and generally embarrassed. But having said that, Trump, after the physical visit, he did sort of come out and give, I would say, a relatively neutral sort of viewpoint. He said things, that Powell will probably serve out his term, no reason to fire him. There's no tension specifically with Powell. I mean, we can wink at that one, but no tension. And I guess he'll do the right thing. That's what Trump's saying. I guess Powell will do the right thing. So what I'm trying to say is that there's like, in public, Trump is putting out a lot of political theater to try and pressure Powell. And Powell, everyone at this point is aware of it. But he's also, playing the cards on the other side by not firing Powell. And so technically, Powell has taken a lot of abuse and pressure for the last, since Trump came in. Excuse me. So now we're about 6 months. So there's no reason, in my humble opinion, why he can't sort of tough it out for another for another sort of period. And that means that we have the Fed meeting next week, you see here on the 30th, so this is next Wednesday. As you can see here, at least by the Fed funds futures pricing, there's a zero possibility of a cut. And if we go out by the end of the year, the first cut is not sort of priced in by the market until October, the end of October. And then in theory, another, one is coming maybe by sort of December, January, February. So at this point, the market is still comfortable that the Fed will cut, once or twice over the next 2, 3, 4, 5 months. And it looks as though the stock market is just doing its kind of thing. Let's just look at a couple of other markets. Next week, we have a lot of stuff. Of course, we have the QRA. We have the Fed, we have job numbers, we have the employment report in the US, which is going to be very important, of course. We also have we had the Bank of Japan, and we have a lot of earnings. We have a lot of the big tech companies, and really next week is the core of the earnings season. So by this time next Friday, we'll have a much better sense of if there's going to be more stimulus coming from either the Treasury or the US government, what the Fed is thinking and thinking of doing, earnings for the big tech companies in the US, Bank of Japan, and of course the QRA, which is sort of the funding situation for the Treasury. But let's just have a look here. I haven't looked at this for a while. This is from Saxo Bank, so thanks to them. Just the trends on FX, and you can see here the volatility is sort of relatively sort of relaxed at this point. The only thing which does seem to be we do continue to have a strength in the European currencies. So we see the euro here just maintaining a relative amount of strength against the US. We can also see the Swiss franc doing pretty well. So both of those doing well, and of course silver, although it's come off a little bit overnight, silver also has been sort of pushing higher. But if we look at some of the other currencies, we can still see that the US dollar is weak, USD. But if you just look here going back, you can see that the strength of the trend in terms of the weakness, got very flat, got down to zero about a week ago, now picking up steam a little bit, but essentially not nearly as weak in terms of the trend. It was down if you go back, what's that, a couple of weeks ago. So over in the commodity currencies, the Aussie, the CAD, New Zealand, really pretty flat at the moment, just seeking more direction. So really, it's really a sense that sort of silver's been pushing higher. We see the JPY continues to remain under pressure, although now that there is a sort of a trade deal. We have the BOJ next week. They could start to sort of think more about normalizing towards the end of the year. Although what I would say is that overnight we did get the Tokyo inflation numbers. So let's just have a look at the USD JPY. And the Tokyo inflation numbers, which is obviously a very important input for the Bank of Japan, they were a little bit lower than expected. And so you see here the US dollar pushing higher overnight against the Japanese yen. So I think that's two things. It's not only the fact that the inflation numbers from the greater Tokyo region were lower than expected last night, which of course in theory would argue for a more dovish BOJ, but also the fact that the data in the US is remains robust, and also the fact that the Fed maybe is under no immediate pressure to cut rates. I mean, politically it's under a huge amount of pressure, but just looking at the data, it may indeed just continue to be neutral, even fractionally hawkish. And that means that we have had a little bit of, let's just look at the US dollar here. If I can find the dollar index, yeah. So the dollar index here, again, it's still, it's still in a downtrend. If we put any kind of metric on that, if we just throw, as we like to do, a bunch of moving averages, we can see that this is still very much in a downtrend. Although, it does see, is this a basing formation? We'll have to see. I mean, the strength of this trend, as we saw just on the Saxo chart, is slowly weakening. And if we look at something like the 20-day moving average and the 50-day moving average, they are possibly starting to sort of flatten out a little bit. It's still early. There's still room for them to keep on going down. If we look at the 100 and the 200 longer term, still those moving averages are pointing downwards. But if we continue to get a Fed which is not cutting, if we continue to have some kind of resolution or stability in the global trade situation, and we continue to have strong US economic data, in my humble opinion, there's no reason why the US dollar cannot sort of find some kind of base here, which is different from saying that it's going to sort of rip, but just for the next sort of few weeks, I don't know, this has to sort of collapse. Having said that, we get a lot of inputs next week. As I said, we get data, we get the Fed, we get the Bank of Japan, we get the QRA, we get earnings, we get a lot of input. So, they could all be US dollar negative. On the other hand, they could all be US dollar positive. And one thing I would say, just to finish on the US dollar quickly, is that what we've seen over the last few weeks is that if you go back to, let's say, April, when we first had the tariffs announced, like April the 2nd, Liberation Day, you could see the US dollar, really fell pretty hard on that. But since then, the US dollar is not actually reacting as much. It's not as sensitive to sort of tariff news. It seems to be, I was looking at a bunch of data yesterday, it's actually reacting much more in a sensitive way. It's much more sensitive now to economic data rather than news of tariffs. So that's an interesting change which we witnessed over the last, kind of 4 to 6 weeks or so. In terms of other currencies, we've got the pound. Where are we? The pound sterling also under a bit of pressure. As I was saying yesterday, the PMIs yesterday were negative. And then this morning, overnight, we had retail sales, which were a little bit soft, a little bit lower than expected. And so what you can see with the pound, we have had a lot of strength in the pound, basically going all of this year, 2025. But we're starting to get a little bit of a toppy formation here, starting to sort of consolidate. And if you look again at these moving averages, you can see here that the 20-day moving average, EMA, is starting to sort of flatten out a little bit. It's threatening to cross over the 50. We're also getting at Fibonacci levels, if we take it from this shorter term one here, starting to get back to fib levels. And if we actually, let's say, take that fib and just extend it maybe to a slightly longer term time frame. So I'm going to extend it down to this impulse, which started on the 8th of April. You can see we're starting to get here to the 38% fib retracement here, which is also a big resistance point. So for sure, any sort of sterling bulls, this would be a very nice sort of entry opportunity around about 133.80. That's going to be a key point there, because if we break down through there, you have to say that maybe there's a little bit more downside to test there. Okay, guys, I'm going to leave it there. A little bit of weakness in the metals overnight. I won't go into that. We have the durable goods, as I say, at 8:30. I don't think we don't have any Fed speakers because they're still in their blackout period. What we do have up here is a huge thunderstorm about to hit. That's why everything's getting a little bit dark. So that's it for today. Have a great weekend, and we'll keep this going next week. Thank you and take care.